We move on to the management of Fin Homes.
Well, yes, that's one of the earnings candidate as well, wherein this time if we see that the profit has seen a jump of 12% on a YY basis, and it's been a good set coming in by the company. So let's understand more what's the way forward with Mr. Suresh Iyer, who is the Managing Director and CEO of Fin Homes, joining us right now. Hi, very good morning, Mr. Iyer, and thank you so much for your time. First of all, when we look at your numbers, so from the last few quarters, your disbursement growth has been a bit volatile. Till when and at what do you expect them to stabilize? What's the outlook when it comes to your disbursements? Are we already seeing some signs of stabilization here?
Actually, in the third quarter, we had a small blip because we had this issue of e-Khata in Karnataka, and we have a very strong presence with 30% of the business coming from Karnataka. But I can say that definitely we are kind of able to resolve it to a large extent. And particularly in the corporation limits, we have been able to get the e-Khatas quite quickly. So therefore, this seems to be a kind of a business that will be able to stabilize and going forward also.
Right. Very good morning to you, Mr. Iyer. This is Cheryl also joining in the conversation, and just wanted to take a leaf out of what we spoke about the disbursement. So I just wanted to add some, just get your view. Have you started disbursements under PMAY 2.0 and also with the rate cuts and PMAY 2.0? How much growth can you we anticipate, especially on that particular front for FY26?
We have started business under PMAY. We have started getting inquiries. But the process is a little longer, and so far the rush has not been like what it was in CLSS earlier. So the number of inquiries that we've got and the conversion, because now there are a lot of steps involved, a lot of verifications that happen at the PMAY side. So because of that, now the trickle which is actually converting from the inquiries to the business is a little less. So while we've had almost 250 plus inquiries coming in from PMAY, the number of cases wherein we are likely to, which have actually converted and are likely to get converted into business is only about 10% of that.
All right, Mr. Iyer, also can you tell us how much was the fresh slippage this particular quarter, and how much have this number has increased for you on a sequential basis?
In terms of the entire year per se, in fact, our gross NPAs have gone up and and it is now 0.87%. But compared to Q3, our SMA 0 has come down by more than 750 crores. And even in terms of NPA, we have actually in absolute numbers also reduced our NPA numbers. So that's as a result of that, in Q4, we've actually had a 10 crore write back in our ECL provisions.
Right. You did speak about the provisions. I just wanted to add on that. So if you could just add up on that and let us understand better, because in your provision management overlay, if you look at that, it's gone up to about 59 crore rupees versus 34 crore rupees on a quarter-on-quarter basis. You did speak about the write back as well. Any other reasons for this rise?
No, basically, it's more of a conservative approach that we have been taking. In the last 2 years, we have kind of built up a management overlay or a kind of a buffer for the NPA management. And in terms of the provisioning for our stage 3 assets, it's continued to be in a range bound around 45% to around 48%. However, in terms of the overall conservative approach that we have taken, hence we have provided for a management overlay of 25 crores. But otherwise, if you look at the overall NPA as a result, ECL provision as a result of the NPAs and other movement in stage 2 also, our credit costs have been below 15 basis points. Actually, it's been around 13 basis points only.
You mentioned the fact that you are being conservative, you are trying to put in a buffer. Is there any issues that you're seeing in a particular account or so? Are we reading too much in between the lines, you think?
No. There is no such thing. In fact, in the last 2 years, if you see that we have consistently been building our management overlay, and it is just post our earlier IRAC norms where we used to have a different provisioning category, and now because of ECL, the PCR actually comes down on stage 3. So as a result, it's more of a conservative approach, and we are just trying to build the reserves. That's about it.
All right, and along with that, Mr. Iyer, if we talk about some of your key geographies in Karnataka and Telangana, these are the two markets where the industry overall was facing pressure, including you. Help us understand how this situation has stabilized and how this geography growth is panning out.
Sure. In actually Karnataka, in fact, we are seeing some improvement. In fact, quite a bit of an improvement because compared to Q3 disbursements, in Q4, we've been able to add almost about approximately 200 crores additional disbursement in Karnataka compared to a Q3. So while they are still below the numbers that we would normally have had this e-khata issue not happened, but still, we are seeing an improvement. So that's a positive thing. And hopefully by this quarter, with the state government also trying its level best to improve the situation, we should be probably back to our old numbers of about 275 crores per month disbursement. Currently, in fact, in January, February, we did about 200 crores. And in March, we were able to do close to 300 crores. So basically, there's been a considerable improvement in Karnataka. Telangana, in fact, has continued to be an issue. In fact, today also there are articles about some demolitions which have happened and constructions and all. So basically, sentiment is down. And we expect that Telangana will be a little slow. We've already slowed down in Telangana considerably over the last 2 years, ever since this issue. The last 1 year, ever since this issue has come up. So we believe that at least from the low base that we have reached, we should be able to manage this growth in Telangana as well. But it will definitely not be the old numbers because that sentiment has been a little affected in Telangana. But Karnataka should come back in Q1 itself, I believe.
Given these situations in these two markets of yours that are pretty important ones, what sort of projections then you have for FY26? Have you penciled in some numbers? What sort of growth numbers that we can watch out for?
Yeah, sure. We are looking at about 20% disbursement growth over current year. So if that should be around 10,500 or plus. So that should give us around 13 to 15% AUM growth for next year. That's what we are targeting. And as I just mentioned, barring Telangana, which has already come down, in fact, Karnataka should be back even by end of Q1 also. And other geographies like North, West, Tamil Nadu and all, they're already doing quite well.
All right, and other than that, what we understand when it comes to your NII number, that has seen a jump of 7.5%. The profit has seen a growth, but what is the outlook for FY26? Help us understand that what is the numbers that you are working with, and along with that, with the rate cuts, what are the expectations that your numbers could get impacted on back of that?
Sure. See, for FY26, we continue to have the same guidance of 2.5% spread and 3.5% net interest margin. And rate cuts we've had an impact, but in the sense that our PSU banks and some of the other banks have actually reduced the rates because banks are mandated to have a EBRR linked pricing. But in terms of the private sector, in terms of the HFCs, we've not had anybody reducing the rates as such. So we have not had, you will also see that in fact, although February there was a rate cut of 25 bips, but our rundown, that is our prepayments and BT outs have not increased. Our Q4 BT out numbers are very much in line with what we have experienced in Q3 and Q2. So we've not seen the impact much on the ground. But yes, the second round of rate cut and going forward, if this continues, one more is expected. In that case, we will have to review our rates. On our liability side, we've already moved all our bank term loans to repo linked. So basically, we will also experience some impact on our liability side. And once we experience reduction in our cost of borrowing, we'll pass it on to our customers. So that's definitely there. For the Q4, we've just had about 5 to 7 bips of benefit, which has accrued from 1st of April. So because, only for 55% of our liability side is linked to banks. So we will be passing on something to our customers going forward.
Right. I just wanted to add on to that and just trying to get some more clarity on that particular front. If you could help us understand your EBLR linked loan book, if you could help us understand how much is that, and also if you could help us understand about the reset time for loan rates. You did speak of the fact that the transition will happen. Any timeline that you can help us with?
See, we have a quarterly reset policy where every quarter, depending on the month of disbursement, the reset will happen. So if somebody has taken a disbursement in the month of February, the reset should happen in the month of May. And we are not actually on the asset side mandated to have a EBLR linked prices. So we will pass on to our customers as and when we experience on our liability side. As for our liability side, we have about 55% of our borrowings coming from the banks. And entire bank portfolio is linked to repo rate or linked to T-bill. So whenever there is a repo rate cut, there will be an impact on our liability side and we'll get some benefit out of it. Depends on each bank term loan the agreement that we have signed. It may happen at the time of the next month, or it may happen at the time of the next interest repayment, which will be at the end of the quarter. So that's how the benefit will accrue to us. And only when we get the benefit on our liability side, we will pass on to our customers.
All right, Mr. Iyer, we let you go on that note. Really appreciate you taking the time out and speaking with us.
Thank you so much. Thank you so much. Appreciate it.
All right, moving on, let's put the spotlight on the